Aloha kakahiaka, everyone. Welcome to the Hawaii Realtors Virtual Connect webinar series. Today's presentation is titled The Future is Now, Recovery and Trends, featuring Paul Brewbaker. Paul is a principal of TZ Economics, a Hawaii economics consultancy firm. His background spans over several decades, and he has lectured and presented on international, monetary, and financial economics. Paul hails from Kailua, Oahu, in the beautiful Olomana area. You may hear the occasional birds chirping and maybe even Manny the landscaper trimming trees in the background. Before Paul begins, I'd like to inform you that this session will be recorded. Also, if you have any technical issues, please type them in the chat box and HAR staff will assist you. Lastly, please enter your questions for Paul in the Q&A box. That's the Q&A box. He'll be answering questions at the end of the presentation. Paul is willing to stay on a little longer, so we may go over the designated hour time frame. Now, without further ado, take it away, Paul.
Good morning, everybody. Aloha, and thanks for inviting me back. I'm going to walk through a slideshow here that I'll copy and make available to the Hawaii Association of Realtors in a PDF format. So if you want a copy, you can get one, and or if you have clients who are interested in some of the material, it would be available to you. At the bottom of each slide, normally there's a series of links to the data sets and other resources that may be of use to you, and I encourage you to explore some of those things on your own. And without further ado, let's get right into it. I want to start by thinking about what's happening with valuations in the housing market as kind of a motivation for the overview, and what I call tiny bubbles. Here are median home prices across the US. This is the US average, adjusted for consumer price inflation over about 50 or 60 years. And you can see the cycles and valuations nationwide, the familiar subprime bubble 15, 20 years ago, and what we call the Japan bubble in Hawaii, the inflation hedging of the late 1970s, and then the great expansion of the 1960s, at that time, the longest expansion in history, 9 years, which I've labeled Camelot. You can see the expansions have been lengthened out in this modern interval, 10 years in the 1990s, 11 years, most recently, aborted by the COVID pandemic, have produced long periods of steady appreciation without the amplitude of the cycles you've seen there in the past. Although the magnitude of these waves, you can see, is within a 2 standard error bandwidth around the long run trend after adjustment for inflation of about 1.25% per annum. That's for the US as a whole. For Hawaii, for the same period, it's closer to 2%. And the question confronting us now is whether that little zig at the end after the COVID-19 event, the little zigzag, is at the bubble, is at the start of a bubble. A lot of people seem to be thinking it is. And so we'll explore some of these issues in the material today. Work from home, the increased acceptance of remote work arrangements between employers and employees that was initially motivated by the biological risk associated with the onset of the pandemic, but has since come to be more widely embraced as the new normal, does seem to be having an impact in the single family detached home segment. Not so much in the condo segment, and this is important because a bubble ought to be raising the values of all housing or all assets in an asset class, similarly. We'll see in several instances that that's not the case so far. Work from home has implications for both residential and commercial real estate. It has spatial implications. People not needing to commute to the urban core are fulfilling their preferences to live in more suburban or ex-urban rural areas. There's a new word, Zoom towns, which is cropping up. And of course, it's having a big impact on food service, on retail in general, and of course, on office space. There's a debate in the urban economics literature between one school of thought that says work from home is a permanent change in workplace behavior and will therefore have an impact we're seeing now that perhaps dissipates as we move away from the change and into the new norm. And another view, which reminds us that cities over the millennia have always been attractors, and that the restoration of urban core living could come as quickly as this year, as the first wave of remote workers abandon the urban core, but the next wave of perhaps younger workers attracted by the lifestyle and benefits of proximity, agglomeration, externalities, we call them in economics, move back in to urban areas that have not seen as much appreciation and are therefore relatively affordable. So we'll be taking a look at these data in a second. Everybody's talking about condo sales, and here are the Oahu data for single family and condo sales through June. And there's no question those condo volumes are exploding, but of course they imploded a year ago, last spring in 2020, in March and April and May, as the initial wave of pandemic infection washed over the planet. If you normalize these data, if you adjust for the fact that they vary over time around an average, which would be the zero benchmark there, then you can see an interesting pattern in the post-COVID rebound. Single-family home sales did not fall as far relative to their own pre-COVID average, and rebounded faster, more vigorously earlier than did condo sales, which fell further, but now have caught up and are maybe overtaking the single-family sales volume. So that if you kind of read between the lines in the press release of the Board of Realtors and in the coverage and in the media, the attention right now is focused on condo sales. But remember that this really interesting pattern where single family sales volumes, although they declined, were more resilient and then rebounded sooner, followed by the catch up in the condo segment, is something we see in the Oahu data. And here are the neighbor island data in their raw form. Again, you see those sharp declines and then a strong rebound on the single family segment, which when you normalize, again, yields this pattern of more vigorous and earlier recovery in single family sales volumes, followed by a catch up and overtaking in the condo segment that we're now seeing from the standpoint of midsummer. And these are data through June of this year. Now we know that the supply chain has been disrupted in the housing segment, in the housing market, housing industry, as in other industries. And one way to think about that is what happened with listings during the pandemic, and then as things began to improve and vaccination began to roll out in this country, versus what was happening in actual absorption. And one of the ways we gauge this, and I'll just show the Oahu data here, is with a statistic called months of inventory remaining. But it's essentially, think of it as the inventory to sales ratio, a common measure you'd see for other industries. And so it's the ratio of sales relative to the inventory, let's say at the end of last month or the start of the period in which we're measuring the sales. And clearly, sales, I mean, single family inventory, did I get that backwards? It's the inventory, what is it? It's the inventory to sales ratio. Anyway, you can see that the single family inventories dropped earlier, even pre-COVID, as I'm sorry, as interest rates normalized in 2018 and 2019, you can see that the inventories piled up in both the single family and condo segment. But then as the Federal Reserve began to reverse its interest rate normalization posture and rates began to fall again in 2019, pre-COVID. Now, nobody knew that COVID was coming. Sales in the single family side took off, but inventories in the condo side on Oahu were piling up, partly because the city chose to double down on its enforcement of the 1989 ban on what I call undocumented vacation rentals. And so as people listed excessive numbers of condos, those inventories piled up. Then the condo hit and the vacation rental market evaporated. And so for a little while there was a fire sale going on in the condo segment. And only in the latter part of 2020 and the early months of 2021 have you seen those condo sales catch up and the absorption begin to draw down the inventory so that the ratio is coming back into alignment. Ordinarily, these two statistics, months of inventory remaining on the single family and condo side, are highly correlated. I mean, for 25 years of data through 2019, or let's say the middle of 2019, the correlation is about 0.96. Whereas if you do the correlation for the 12 or 18 months thereafter, it's more like minus 0.65. So you can see they moved in opposite directions, which was really unusual. But they recently have converged, suggesting in the housing market that the supply chain disruption, so to speak, is being resolved. Now, there's another part of supply, of course, which is production, new home building. And as is now legendary, because we've all lived it and are living in the twilight of civilization as far as home building in Hawaii is concerned, we just don't build. Not only do we not build hardly any new homes in Hawaii anymore, but you can't get permission to build them even if you tried. So there were fewer homes authorized by building permit. Those are fewer housing units permitted, allowed to be built on Oahu in 2020 than there were in 1928. And it's so good, the last decade of home building for Honolulu, only World War was worse. You can just see what has happened in the breakdown on Oahu. And a similar phenomenon has happened on the neighbor islands. A long, extended downward spiral cycling around a lower trend, part of which has to do with lower population growth, to be sure. And of course, the statehood moment, kind of an opening where Hawaii was an emerging market economy for 2 or 3 decades, was notably distinct from the last 20 or 30 years, which have kind of been, working for the clampdown. We can break these down by island, and I have quarterly data now, high frequency data, going way, way back. I've been spending the last 10 years compiling ancient data sets. So I have, what is this, back to 19, I can't see the way my Zoom screen is set up. But these data for Oahu go back to, I think, what does it say? Can you guys read it? 61 or something like that? And you can clearly see the downward trend in the lower left-hand corner. I mean, you don't need to decompose the data mathematically, although I've extracted the cycle and I've extracted the noise there on the right side of your screen. But that downward trend is profound. And as you can see, the volumes we build in a good year today are about what we used to build in a bad year during the last half century on Oahu. On the Big Island, we're cycling around a relatively stable trend volume in the decades from the late 1970s through the early 2000s was the norm. And you can see those cycles again on the right side of your screen. Something happened. I don't know what happened on the Big Island, but something broke. And you can see now the trend that comes out of the data when you apply these filters. Same thing on Maui, where we know that first a 50% affordable housing rule, and then more recently a 75% affordable housing rule were adopted by the infinitely wise Maui County Council. And so, you know, if you want to crush home building, that's how you do it, raise the affordable housing requirement. And that cycle, by the way, on Maui is shared on Kauai, for which I don't have as much data. This Maui data set goes back to 1961. So that's essentially the beginning of all time for the statehood area. And we're just not in a world today where you're going to be allowed to build housing. And so you look at these markets on Kauai and Maui now, where there's not that much inventory, you know, to be had to begin with. People were hoarding inventory during the biological crisis. Like why would I leave the safety of my house for the uncertainty of what I might find if I go out there and try to move? That was a factor for much of last year. It's abated now. People are starting to bust a move, but the fact remains that these production data don't lie. That's really what's happening. I heard a report that Maui hired somebody to do a study that said, here's a news flash, we need more affordable housing. No duh. And they proposed 1,000 units per year for the next 5 years. And I'm like, well, dude, we did that back in, you know, this is Kauai there. Maui did that. Maui built 2,000 housing units per year on trend for all of the 1970s without computers. So it's been done. But in order to get there, you probably have to change the way things are done now. A lot of concern, another factor here, that a lot of concern that building costs have risen as a result of supply chain disruptions in building materials industries. I'm showing you producer price indices here for iron and steel, which are consolidated, and for lumber. So that happened. You know, 100, 200% increases in the costs of these raw materials that, you know, translate into the cost of building materials. The good news is that as those supply chain disruptions are also resolved, the prices start to come down. So these are lumber futures prices up until July 5th, and these are daily data. And you can see lumber prices have fallen by half in the last month or two. So again, a sign, you know, what happens is when lumber prices go up, all of the producers in that supply chain, from the, you know, from the forest owners to the loggers to the mills to the distributors to the people who do the engineered wood products, they all jump into action to grab some of that money. The difference between these supply chains and the housing supply chain in Hawaii is that when you jump into action, somebody shows up to sue you because they have standing and your project is done. But as I say, the building materials inflation is probably transitory. And I imagine we're seeing some of the same phenomenon in consumer prices generally. We may have time to talk about that at the end. I have some appended materials. So let's drill down and look at housing price dynamics specifically. What's happening in each housing segment in terms of valuation dynamics by each of the 4 counties. So here are the Oahu data, and pretty much the same thing is happening on every island. You can see the stagnation in valuations in 2018 and 2019 as Hawaii's economy hit a speed bump. So in the 20 teens on Oahu, price appreciation was about 4% in the single family side and 5% on the condo side, the more affordable segment. And as we all know, the economy was growing nationwide, and sort of in Hawaii until the middle of 2018. Maybe it was a volcano. On Kauai, it was the flood. Whatever happened, valuations stopped rising. And you can see them on Oahu, which did not have a volcano. You can see them going sideways in 2018 and 2019. Now, part of that was probably rising interest rates as the Fed began to normalize monetary policy, a posture it reversed at the end of, in the course of 2019, at the end of 2018, and in the course of 2019. But still, 2019 was not a great year for Hawaii. For example, everybody keeps telling me tourism was a record, and that's just not true. Tourism receipts after inflation declined in 2019. So the biggest export actually decreased outright in 2019, and GDP growth in 2018 and 19 for Hawaii was essentially zero. So the flattening of home price movements on Oahu in that interval at the end of the 20 teens was a reflection of things going on in the underlying economy. It was not that good in Hawaii. Hawaii was, certainly Oahu was, well, the neighbor islands were falling behind as well as Oahu, but Hawaii as a whole were falling behind the national pattern of economic growth at that time. And then came COVID. And you would have thought in the middle of a pandemic that that would be the death blow, right? If you weren't already dead, you would be dead. The housing market would be dead after COVID-19. And an amazing thing happened, which is that demand for single family homes exploded. And of course, nobody's ever going to be allowed to build them unless, like Castle and Cooke, they wait 20 years, go to the Hawaii State Supreme Court 2 times to get permission to build on land they've already owned for a century or more across the street from Costco at a freeway off-ramp, right? That's, if you can't build houses on land next to a freeway off-ramp across the street from a Costco, your system is, I mean, you just don't understand what's going on with the system. And that demand for single-family homes in the wake of the pandemic event is really notable because it did not show up as much, if at all, in the condo segment. Condo prices on Oahu, notwithstanding the robustness of the increase in condo sales volumes, especially this year, especially catching up to the single family segment, remain at the lower end, a lower bound of the 2 standard error, the 99% confidence interval, around that 5% trend. You would say, well, I'm pretty confident that we're still, in the condo segment, the valuations are still following the longer run 5% or medium run 5% trend appreciation. We're at the lower bound of that range. It's acceptable, but we're still kind of in the zone or right at the boundary. But you certainly would have to interpret what's happening in the single family segment as an eruption, as an explosion outside the upper bound of that trend. Although it may have peaked, you may just miss the peak. The June data, when you seasonally adjust it, right, take into account the fact that June's always more robust than May. It turns out that May was actually the peak month, that little zigzag there where I've written 973K. That's my number, right? I get the Honolulu Board of Realtors data, monthly data, I seasonally adjust them. That's what I get. Not exactly the same thing as what they get. And you see this pattern now that you've imprinted it on your brain for Oahu, which is so boring, right? Who cares about Oahu? Here's the data for, what is this, Kauai? I can't see, let me move my thing here. There's the data for Kauai. And again, you see that eruption on the single family side, right to the upper bound of the bandwidth associated with the appreciation over the previous half decade or decade of the 20 teens. The numbers on the neighbor islands, by the way, the trend appreciation rates are more like, on Oahu, they're say 4 or 5%. On the neighbor islands, they were more like 6 or 7%, okay, in the 20 teens. So a faster appreciation rate coming out of a deeper trough following the financial crisis and Great Depression of 2008 and 9, but a very notable post-COVID explosion on the single family side, not quite matched on the condo side in the Kauai data, and notably prices moving up above the $1 million threshold, which of course they were going to anyway in about 5 minutes, but they're racing ahead of the trend that would have gotten us there anyway by the end of next year. So there may be, 18 months ahead of schedule. I don't know why anybody's surprised by this, by the way. We were going to get there. The escalator was going to take you there anyway. Here are the Maui data. Again, is that Maui? Yep, very similar pattern. Again, the headline in the newspaper is that it's busted out above $1 million, $1 million, as Dr. Evil would say. And I've seasonally adjusted these data, so they get 1.1 something, I get 1.099 because I've seasonally adjusted it. June is always a robust month, so I take that into account here. But everybody's focused on punching through the 1 million threshold, which is a completely arbitrary number, right? It's, nobody was waiting for 1.0001 or 0.999999. And again, we would have gotten there at the higher 6-7% appreciation rate that the neighbor islands were experiencing. We would have gotten there anyway, as you can see here at the end of 2022. So we're about 18 months ahead of schedule, and condo valuations are not exhibiting the same robustness that you see on the single family side. Big Island is more complex, and we looked at these data earlier in the year in another meeting arranged by the MLS provider. And by the way, thank you to Hawaii Information Service and Realtors Association of Maui and the Honolulu Board of Realtors for always making your data available to me. It's really appreciated, and I try to give back to the industry for that courtesy. But Big Island is different because it's really 3 different islands, as it turns out. The more affordable Hilo side, I like to segregate the Condo Data tax map key 9 because they have their own thing going on down there. And on the Big Island, the volcanic eruption, the East Rift eruption in May of 2018, May through August, does appear to have had an impact. The stagnation in price appreciation that we observed in the other counties might have occurred anyway on the Big Island, but of course that eruption was a notable break. And what you can see was a period of decelerating appreciation, that curvature, right? You see the little bit of curvature in those single family home price movements on the Big Island. That curvature means that prices were rising faster in the early part of the 20 teens than they were in the middle to latter part. But again, evidence of a breakout in all of these market segments, and certainly in Kona, which is a market that on the Kona side, on the west side, Big Island's west side, it certainly is more reminiscent of what you find in Kauai and Maui prices. We can drill down analytically. I'll do this relatively quickly, right? You can detrend the data and then look for evidence of what we're talking about, this dichotomy between single family valuation breakouts and condos that are keeping up now in terms of volumes, but not as much in terms of prices. So let's dig in. I'm just going to use the Oahu data as an example, but you can do this with the family at home if you want on your own island's data set. So I'll take the trend from single family prices on Oahu, right? And I'll extract the trend from the condo prices on Oahu, and you can see those 2 bubbles, the Japan bubble, the subprime bubble, even the hedging bubble and the inflation hedging bubble in the late 1970s sort of peeking through at the beginning of this window. I'll detrend these 2 median price series and segregate the cycle from the non-cyclical component, and they're way over on the right side of the page, and I'll shake my mouse arrow around it. Zounds, a big jump in the the irregular component of single family price movements, and not so much on the condo side. And then a final way of digging into the analytics is to look at the underlying distributions of home prices themselves. Ordinarily, this is an Oahu example. Ordinarily, the price distributions migrate over time in what visually is a relatively orderly pattern. But what you see right now, if you start the clock ticking in March 2020, so right when the lockdowns began, start the clock ticking in March 2020 and define years from March, I'm sorry, is it March second quarter, my bad, from April through March of the subsequent year, right? So I'm gonna have a year starting in April of 2020, ending in March 2021. I'll compare that to the previous 12 months. And just for good measure, let's compare to the 12 months prior to that. And what you see on the condo side is not that much change in the shape of the home price distribution on Oahu. There's that, the heavy black dashed line is the most recent 4-quarter distribution. And it looks like there's more transactions, around the 300,000 to 400,000 part of the distribution, which is why condos are more affordable. That's a fact, Jack. Much less of a shift in the distribution than you see in the single family segment, where the post-COVID distribution has punched out in that 1 million to 1.25 to 1.5, sort of in the 1 to 2 million part of the distribution. The transactions are punching out. There's more observations in the 1 to 2 million range than you saw in the prior 12-month period or the 12 months prior to that. If you benchmark to second quarter 2020 or second quarter in each of the last several years as the start of the interval. So that's really telling. That resonates again with what we saw in these other decompositions of the data. Single family prices are moving, and here what we're showing is they're really moving at the high end, right? There's a lot of transactions. Well, we used to call it the high end. Now it's the median. So they're moving in the above median segment, 1 to 2 million. On the neighbor islands, we see, I'm not going to show all the data, and I've already skipped over condos on the Big Island. Let's just look at Kona and at Kauai, again in the single family segment, at the pre and post COVID comparisons. And there again, you see in that sort of 1.25 to 3 million, frame is where the sales volumes are punching out, and where the sales volumes in the what used to be the median 5-10 years ago in the 500,000 to 700,000 range. Those transactions volumes are declining. By comparison, same scales, same horizontal scales in the Hilo and Ka'u single family home segments, as in the condo segment on Oahu, but for Hilo and Ka'u, which is mostly single family homes anyway, because it's Big Island, the distributions are not changing. The affordable markets are staying relatively affordable. I mean, there's a small kind increase if you look at the post-COVID distribution for Ka'u, but nothing like what you see in Kauai and to a certain extent in Kona. And I haven't gotten the Maui data lately. We haven't been in touch. And so I haven't been able to look at their data set. The formal statistics are here. I'll just show you that, these big jumps in Oahu single family average prices, which are over $1 million now, the median's not quite. Again, for these 4-quarter pre and post COVID comparisons are notable, and the higher order moments, of the distributions, the ones that sort of are the indication of that bulge we were looking at, are the big factors. For example, if you look at the Kauai market, where I've highlighted the quadrupling of kurtosis, the fourth moment of the distribution. So something's going on out there. It's at least initially affected the single family market segment more than the condo segment. The condos are catching up now. We have yet to see a lot of evidence of accelerated appreciation of condominium prices in terms of measures of center of tendency, like the median or the mean home price. and certainly in those higher order moments that I looked at it just a minute ago. It's also instructive to look at what's happening by neighborhoods for evidence of what is called the donut effect, which is abandonment of the urban core and migration to the suburban and exurban outer bounds. If you think of, space on an island. So the Oahu data from 2020, the neighborhood data give you a little feel for this. Top 4 or 5 neighborhoods for price appreciation in 2020 were North Shore, Hawaii Kai, and Aina Haina, Kuli'o'o. That's kind of east Oahu. So North Shore, East Oahu, what I call the Highlands, Makakilo, Mililani, windward side, Kailua Waimanalo, and then coming in a little bit, Moanalua, Wahiawa, but definitely a movement away from the urban core. Look at Ala Moana, Kapahulu, Nu'uanu areas at the bottom of the list, actually experiencing depreciation, not of every house, right? These are the medians, but you can think of the distributions we were just looking at. Think of them shape shifting, and so in the suburbs and exurbs and the highlands of Mililani and Makakilo, you can see the transactions in the 1 to 2 million range kind of bulging out, so to speak, and that shows up in these median prices. Here are the here we skipped over some Maui data in the last segment, so I'll show you some Maui data from Maui County data from 2020. Number 1 neighborhood in Maui County last year, Molokai, woohoo! And followed by all West Maui areas, Lahaina, Kapalua, Ka'anapali. And for the county as a whole, and for the urban conurbations, like Kahului, Waikulua, Wailuku, not nearly as robust movement, and you see there in West Maui and Molokai. Talk about an exurb. For the first 5 months of 2021, and now that I'm showing you this slide, the Honolulu Board of Realtors, I promise you, will post the new data set tomorrow to include June, but so you'll have first half 2021 data available later this week, I feel certain. But I waited and never saw it, so I finally got up this morning and did the first 5 months. And again, you see this pattern, but it's starting to shift. So now downtown Nu'uanu is back in the top 5, which again has kind of a North Shore windward flavor. Kaneohe's in there. And when you look at the condo segment, again, you see, right, the condos are sort of coming alive now, and you see this donut effect present. It's more like West Oahu, is out there in the appreciation part, and urban core is kind of not doing that well. Now, that doesn't mean if you sell your condo in the urban core that it's going to have a lower price. It's just saying that the lower priced unit, or that it's possible that the lower priced units are the ones that are selling, right? So that the median is going down in the urban core because there's a backwash of people moving in to grab lower valued condos. Now this first wave of the donut effect has occurred. That's a hypothesis, by the way. I'm not really sure what's going on here, but you got to look at these patterns, you guys. There's a thing happening for condos. Lanai, which is its own sort of universe, was the cray market for Maui County in, I think this is 2020, right? But again, you see the pattern we saw earlier with Molokai and West Maui really showing up. Although there's Paia, so good for you guys. So, and I'm sorry, did I get that wrong? Was this was the hell was this? This was condos, and then is this condos January through May 2021. So I had that totally backwards. This was condos in 2020, and then here's the condos in the first part of 2021, where again, the top, the demand is kind of moving across the island from the urban core, and which is either languishing or appreciating at a lot lower rates. So single family prices exploded, condo prices not so much, although they're starting to get more vigor in terms of sales volumes. Sales dropped after COVID, but listings evaporated initially, and then vacation rentals were being dumped as cash flows went to zero by small investors. A lot of vacation rentals are just individual investors who can't handle 6 months of zero cash flow. So a fire sales externality, it's called, where pressure on those prices pushes the whole market segment downward, has characterized 2020. And then coming into 2021, we're seeing a reversal. And this has happened so quickly now in the first half of this year. I'm just starting to recognize it in the last month or two. I don't even have a slide for that. I got to add a bullet point here that I think things are changing. The basic idea about what I think is going on here is that the proportion of workers who no longer will primarily engage in their work at a conventional workplace, the proportion of workers working remotely, either all the time or in some kind of hybrid arrangement where they only go in to a collaborative workspace like an office 2 or 3 days a week, I think the proportion of those kinds of workers has experienced a one-time upward adjustment. And as a consequence of that, there's a one-time impulse of demand for these suburban or exurban detached dwellings, right? Part of the COVID thing is distancing. You don't want to have to get in an elevator. Now we're moving beyond that with vaccination and whatnot, which is restoring getting on elevators and going out to eat and hanging around at Target or lolling about the mall. None of which I'm doing yet, by the way, but I realize that people are feeling more comfortable and are starting to hang out at Starbucks again. But that shift in the pattern of work has resulted in a one-time pulse of housing demand. If it was just low interest rates, it would have affected both single family and condo markets, if not exactly equally, then more similarly than has been the case. So there's got to be something else that's going on. And I think it's these workforce changes. So let me just give you a feel for what we see in the national data. And you'll have, we just don't know how much of this is happening in Hawaii. We're kind of living it. But it's quite compelling. Pre-COVID, before March of last year, 2020, 90% of American workers had never worked from home. Okay, pre-COVID, before March 2020, only 10% of workers had ever worked at home and less than 5% worked from home full-time. Within 2 months, by May 2020, when this survey was conducted, respondents reported that fully 25% of workers, up from 10%, only 5 percentage points of which work from home full-time, that fully a quarter of American workers probably work from home at least a few days a week. That's an extraordinary one-time shift. And as we followed these behavioral shifts and pattern changes, workplace pattern changes over the course of the last 12 months, this is a survey from January, where majorities of respondents to this particular survey of firms were saying that all or most employees had worked from home or were adopting new work from home policies because of the health crisis. And the stigma that used to be attached to working at home, right? You call it work from home, your boss calls it shirk from home. And the stigma that used to be attached to working from home, that you're probably faking it, that you're watching TV while you're moving your mouse around so that your company's surveillance system thinks that you're actually at your computer, that stigma has completely evaporated. And when you ask firms which engaged in remote work for the first time during the COVID pandemic, how things worked out, amazingly large proportions of survey respondents say that things worked out better than ever. So there's a distinct pattern in terms of level of educational attainment, where persons with higher educational attainment and therefore the most productive in the sense of the complementarity of their analytical and critical thinking skills with the technology that we use today to conduct work, that those workers are the ones that are more likely to be able to continue working at home. And in addition to the 10 percentage points who work from home pre-pandemic, as of May of this year, I haven't looked up the June numbers, an additional 15 to 20% of all workers, so 25 to 30% of all workers were still working at home, and even larger proportions with higher educational attainment. Unlike previous recessions, during which productivity declines and then rebounds in the recovery, productivity increased during the COVID recession, right? Ordinarily, when recession comes, people aren't producing as much during the recession if they can retain their jobs. Productivity goes down, and then when the recovery comes, employment, reemployment is slow to accumulate, as is the case now. People are slow to hire, so the existing workers produce more per person, and you have a productivity jump that follows every recession during the recovery. This time, productivity went up during the recession. That's new. And you can see in other patterns, this is investment in equipment and stuff. We invest in residential structures, it's capital formation in residential structures, in commercial structures. This is investment, this is capital formation in equipment and software, intellectual property, and an explosion of investment, essentially in technology, which we know is productivity enhancing, associated with this recession. All your kids who went to school remotely last year have a better laptop computer than they did 2 years ago. A fascinating statistic here, the number of applications for a federal employer identification number, a federal EIN, exploded after COVID-19. It's like an unleashing of entrepreneurship in America. I thought this was going to be a one-time thing. It's starting to look like a step function. It's permanently increased, and you're hearing a lot of reports of how hard it is to hire people. That's because they just started an internet business and they're not going back to your lousy job. We see those data in what's called the Beveridge curve, which relates the unemployment rate to the number of job openings. So an historic high number of job openings relative to the current unemployment rate, around 6%. It's never been like this. So you would think at 6% unemployment that people would be dying to get a job. And no, this is not about extended unemployment insurance benefits. This is, unemployment insurance, yeah, the federal, besides, that's going to end. These numbers are not going to drop after the unemployment insurance bumps go away. There's something structural going on out there. And if you look at labor force participation, young people are going back to work, but the old duffers are saying, yeah, hell no, I ain't going back to that job. These labor force participation rates do vary a lot by age. So the older buggers that are waiting to go back to work, they figure, I'm going to take my time this time. But notice that the teens, when boomers were teens, more than half of them were labor force participants. And today, I think partly because, well, maybe some of them are gaming or streaming Netflix or making TikTok videos. But I think for teens today, the opportunity cost of education and higher education in particular is much higher. That is, if you don't have a higher education, if you're a teenager and you're not preparing yourself to acquire higher education, you're going to miss out on for the rest of your life. And people recognize that. And so they're spending more time. My interpretation of the data here are that they're spending less time in the conventional workforce, and they're spending more time investing in human capital, which is appropriate. So how do we pull all these things together? I don't think there's an asset pricing bubble per se. I know a lot of people are jumping to that assessment, to that conclusion. Bubbles usually are detached from economic fundamentals. There's a strong fundamental reason for the robustness of some home price movements rooted in low interest rates. Bubbles usually are characterized by an information asymmetry where some people know something about, say, GameStop stock, but other people don't. And so you see herding, like the Reddit investors that are piling into AMC or Bitcoin, and you see this in a bubble. You usually hear people talk more about what they think other people think, right? They're buying the condo because they think they can flip it to that guy over there who thinks that prices are going to be higher, right? So their expectations are really about other people's expectations rather than fundamentally what's going on in an asset class. And I don't see those elements at work here. This housing is not experiencing a mean bubble. That is to say, the fundamentals are consistent with a robust housing market, low interest rates, strong recovery. Everybody's 401k is looking pretty good based on stock market performance. We had a transitory, a biological risk event, and it led many investors to look for longer lived assets as safe havens, and literally houses are a safe haven, which, the S&P 500 index fund, you can't live in a bond fund, but you can live in a house with a little yard and protect yourself and your family and maybe work from home. And that unique post-COVID outcome, the donut effect, to which I've referred and about which there's a literature, so I've provided all the links, so you go read about this yourself, is a reflection of this shift in housing preferences towards the suburbs, the exurbs, and Zoom towns across rural America. Top 4 states for population growth in 2020: Idaho, Utah, Nevada, Arizona, in no particular order. Top 4 states: Idaho, Utah, Nevada, Arizona. You got to think about that for a second. Inelastic supply, the supply constraint that we face, especially in Hawaii, they're not going to let you build. Means that when demand for housing goes up, the only thing that can happen is prices rise to clear the market, because they are not going to let you build. They say they want affordable housing, but really they just don't want any more housing. They don't want any more tourists. They don't want any more telescopes. They don't want any more GMOs, and they certainly don't want the super freaking ferry, right? They are not going to let you build. So when demand increases, if supply is inelastic, the only thing that happens is that prices go up. And you're seeing a variation of bubbleiciousness in the single family segment in most markets, definitely Oahu, Maui, Kauai, maybe west side of Big Island, but you're not seeing it yet, at any rate. You're not seeing it in condos. You haven't seen it over the last year. Stay tuned. It could migrate back into the urban core, and there is this alternate hypothesis to the donut effect, but the donut effect is just the beginning. The first wave of migration is out of the urban core. The next wave of migration is a backwash into the city, and you're starting to see that now in places like Manhattan and San Francisco. The novel coronavirus had a novel impact on our housing market. Tourists were absent for at least 6 months, up to a year. That ran vacation rental cash flow to nil and blew up the people that were investors in that market segment. Remote work has completely changed the employment landscape, and certainly the urban scape. The office vacancy rates are going up, and I don't think that's changing. I'm just delighted for Windward Mall that Target has decided to move in there, but I'm pretty sure that e-commerce blew up a bunch of retail names and a bunch of retail space. So we'll have to see how remote work in particular and these generalized patterns of change in commercial space utilization and the rise in the impetus to further expansion of apps and AI and algorithms and all this other stuff, all the way through the supply chain, are going to manifest themselves in our residential as well as commercial real estate markets. And finally, I think I have some data in the appendix, but it should be remembered that residents were leaving Oahu pre-COVID for 3 or 4 years, and they were leaving Maui now, as it turns out, for at least 1 year prior to COVID, in numbers larger than all other sources of population growth combined. So you have to be concerned about the 2020s, whether we're actually going to be a state that people move to. Yes, the remote workers, the vagabond workers seem to be coming here. And of course, a lot of them are just residents that are delighted to be able to keep their job at eBay, but come home to live in Hawaii. And that also means, however, that you can move somewhere cheap on the mainland and keep your job here in Hawaii. So we'll see how this all works out. There's a point here is that against the recent backdrop of this extraordinarily disruptive event of the COVID pandemic, which isn't over yet, the variants are coming to get your kids this fall. I'm just telling you, you gotta watch out. We've had this additional factor that people haven't been talking about enough, which is the population in Hawaii is declining, right? Honolulu is going the way of Detroit. It's early days, but if things stay the way they are, the 2020s could actually be a decade where we solve the housing crisis by abandoning the homes. And with that, I will stop and turn us over. Wow, good thing. No time for questions. Awesome. Ethel, do you want to, should we go into overtime?
Yeah, just to remind people to please submit their questions into the Q&A box, please. First question, Paul, what's driving?
If you have to go, an hour, nobody should ever spend more than an hour listening to me. So if you have to go, I understand. We'll spend another 15, 20 minutes on Q&A, and I'll try to work it out. Well, it'll be recorded, so you can come back and listen later. I know if you have to go at 11, you got to go. So mahalo for that. And thanks, Ethel. Yeah, let's think about the first question here.
Okay, first question. What's driving the increase in inflation, and should we be concerned about it? Also,
well,
go ahead.
No. And there's a second part to the question.
How might this affect Hawaii's real estate market?
Yeah. So let's start with the latter part. In the past, and the 1970s is sort of the classic example, when we had a big inflation surge, people's asset portfolio preferences rotate over towards real assets, right? So they flee to commodities, they flee to real estate, where inflation may exist, but a house is still a house, and it's a real asset. So they tend to move towards real asset classes to protect themselves against the inflation. Now, the thing we learned in the 1970s in America about inflation is that we never want to go through that again. It was not an hyperinflation, by the way. So it was nothing like what you see in places like Venezuela recently. But it was an inflation in which we had double-digit rates of consumer price increase, for example, and it did precipitate an increase in demand for commodities and real estate. And of course, it raised mortgage interest rates because nominal interest rates include an inflation premium. So Ethel and I lived through an experience of 15 to 20% inflation, which was accompanied by 15 to 20% mortgage interest rates back in those days. I don't think we're seeing that kind of event right now. So my guess is that the effect will not end up being what it was in 1970. For the first thing, the Federal Reserve learned how to manage inflation, and we learned that they're committed to managing inflation to relatively low rates, a 2% policy objective. So I don't think that's going to happen. The reason we're seeing the inflation right now is primarily transitory. If you look at the underlying data, most of the inflation is actually in used cars and liquid fuels. Some of it's showing up in food, but here's a new flash. food is so cheap in America, we're obese and diabetic. So if you look at how much food prices have gone up, or apparel over the last 40 years, it's next to nothing. And yes, I'm sorry, the price of milk is going up right now, but in the bigger picture, it's not really a thing. Let me just show you a couple data sets here. So you read about people being concerned about inflation and hear them on television, because that's who gets to be on television, right? The guy who screams the loudest. That's why I get on television, right? And if you actually look at what people are putting their money on, right, when they invest in US Treasury securities, the bets that the global investor community is making right now are consistent with an inflation expectation over the next 5 to 30 years of about 2.5%. Right now, the Fed's goal is 2%. That actually translates into 2.5% in terms of the consumer price index. The Fed states its objective in terms of what's called the personal consumption expenditure deflator. But the point is here that we can observe what financial markets actually expect in terms of the pricing of treasury bonds that have nominal yields, which include inflation, and real yields, or treasury inflation protected securities, in which an inflation adjustment and inflation compensation is embedded. So whatever's going on in the newspaper or in the data, because there's definitely a short-term thing happening, and at the gas pump, right, and in the milk aisle, it looks more like a transitory phenomenon. The 5% inflation we're talking about nationwide, the last Honolulu number was 3.8%. So we don't have a new number. The July number will be the next Honolulu number. The 5% inflation we're talking about nationwide, we last saw in the late 2000s. Now, I don't remember anybody's head exploding back then, because we were too busy getting subprime loans and building too many houses momentarily. And back when they let you actually build houses. And yes, this is scary, but you know what it really looks like? It looks like those lumber prices it looks like it's a short-term supply chain thing. And I'm pretty sure that's what's going on. Here, by the way, are those inventory to sales ratios for retail and manufacturing. And just the way to think about this is retail inventories are really low right now because everybody's going back and to the store and spending their stimulus checks and whatnot, and spending the money they saved up last year while they hid out in their houses. Whereas manufacturing inventories are piling up as producers at the factories gear up again. But the supply chain, the supply chain connecting the manufacturers to the retails is still disrupted, right? There's still a gap between the inventories in the manufacturing sector and the inventories in the retail sector that has to be closed by moving the product across the ocean, across the country. Okay, and that, as I say, it's literally a supply chain disruption that's being resolved right now. And I'll stop there. These are the numbers, people are forecasting. 2s and 3s, not 5s, and certainly not double digits. What's the next question?
Next question. When calculating absorption rate, in parentheses, month supply, do you count pendings as active or as sold, or do you ignore them altogether?
I just download whatever the Board of Realtors publishes, and everybody does it kind of the same way. For example, some places will use a moving average. And I've done it. In fact, I have other slideshows for some of the other realtor groups with which I've spoken, where you can look at new listings relative to the newly listed inventory to sales ratio, or all listings to the sales rate. They all show the same thing. They all show that pileup of inventory, and then a subsequent absorption, a catch up in the condo market. So whatever was happening, it's over now. But I introduced it, and I introduced it with only one slide. We could do it for all the counties, and you can use months of inventory remaining, or you can use days on market, right? It's sort of the different ways of getting at the same thing. As I say, you can look at new listings, you can look at all listings, the ones that carryovers from past months, and you sort of get the same impression that there was a little bit of a pileup last year, especially in the condo side, partly because people weren't listing their homes, right? They were kind of hoarding, they're hiding out, and of course, as I pointed out, the supply chain for new houses is, virtually is down to a drip, right? There's 1,200 units, not even, was it 1,200 units authorized by building permit last year? 10 times that many were authorized by building permit when I graduated from high school 40 years ago, right? So when I graduated from high school, when a computer was Pong, you connect to your TV, you can play Pong on your TV, that was a computer. 13,000 housing units per year were being built on Oahu. And last year it was 1,200 with smartphones. So the supply part of this, listings as well as new product, really, really dwindled last year. Absorption went, demand went in the opposite direction. We expected demand to shut down. It did for a couple of months and then it exploded. And part of it is, as I say, this sort of shift to, in preferences towards detached dwellings that may be shifting back now to multifamily and urban density from a temporary hiatus. But yeah, you can do it any of the different ways that are done. You can look at months of inventory. What's the other one? Anyway, I don't look at all of them. I look at a couple, and it kind of doesn't matter how you approach it.
Okay, how realistic is it that the state would start to turn toward limiting tourism to preserve the asset of the beaches, etc.?
What was the verb?
How
Or
realistic
what was the adjective?
is it
How
that,
realistic?
yeah, realistic.
I'm not sure. It sounds insane to me. So, right, Maui's doing this right now. So Maui had 80,000 people employed pre-COVID. Then it had 60,000 people employed. And what it's saying, some people over there are saying is, we like the beach empty. Those 20,000 people who lost their job can go pound sand and move to Oklahoma. Nice. Is that what we're talking about? Because it seems like that's what we're talking about. So, yeah, I don't know. How much does it cost, to go on the trail? Nothing? Well, maybe that explains why there's too many people there. There's no question there's a management issue, and we are not managing the negative externalities from open access, recreational, renewable natural resources. We're not doing diddly about that. So, but telling the airlines to stop flying planes to your island, that's like, hey, you know what? Stay the hell away from my side of the island. That's what I say. Is that the conversation we're having now? So is it realistic? I don't know. Seems like it's happening. Seems like that's what people are doing, right? Was it realistic that we would not build houses for young people that are born and then grow up and want to move out of their parents' house? Doesn't seem realistic that we would do that. We just did that. We just did that for 50 years. So why would we not shut down? You got me. After the last 4 or 5 years of national politics, anything that can happen. It seems insane to me, but it doesn't seem unrealistic that it could happen. And there are people literally making that argument, and majorities of people in public leadership that are making decisions of that sort. I think there's a management solution, but yeah, that's the home. Yeah.
Okay, with the eviction moratorium coming to an end, combined with the undealt with illegal vacation rentals, When do you think inventory will start beginning impacting, and do you think it will mostly be condos versus single-family homes?
Yeah, so look, does anybody think it's realistic to believe that vacation rentals are going away? So what exactly is the scenario here? Hosting apps don't matter. We're going to make vacation rentals go away because prohibition always works. And I mean, again, there's a management issue, right? But Honolulu, Oahu is faking it. Oahu banned vacation rentals in 1989. Then it chose not to enforce the ban for 30 years. And then 2 years ago, it said, okay, now we're going to enforce it. As if. And their way of enforcing it is to have the neighbors call up and narc on the guy next door. Like, wow, not see much? What are people even talking about? So, I'm just saying, realistically, they're not going away. I mean, you got to see these data, you guys. Do I have it in here? Do I have it in this slideshow? No, I don't. I don't think I have all this stuff, but I don't have that. I've stopped screen sharing, but I could find it for you. Look, all of the growth in lodging in Hawaii for 30 years has been vacation rentals. Let me say that again. All of the growth in the lodging inventory in Hawaii, all of the net increase in the lodging inventory in Hawaii in the last 30 years is vacation rentals. So I don't know. If you think they're going away, I mean, if you want them to go away, good luck with that. My guess is they're here to stay, that there's a vacation rental coming to a neighborhood like yours, that you're going to be operating a vacation rental at some point. And so this speculation about, well, when we solve that problem, when we get rid of the vacation rentals, then there'll be sufficient, then there will be affordable housing. I don't understand how, I use that example because policymakers, this is when I talk with a lot of policymakers, that's what they think is going to happen. We're going to get we're going to contain the vacation rentals, and then there'll be more affordable housing. And I'm like, you could just let people build more housing. I mean, if you build 13,000 housing units, a bunch of it's going to be more affordable. I'm just saying, when I go, everybody's first apartment was some junk 4-story cinder block walk-up that was built in 1973 because it was affordable, because they built 13,000 housing units in 1973. So I think it's just the question, to me, the way the question was framed leads me down a path that I don't think is realistic. I don't think it's realistic to expect that vacation renters are going to go away. And there's no, I don't see any meaningful management of them, which, by the way, that's right there. Here's the management. It's just an app. Just make an app. So anyway,
Let's call this
yeah,
the,
yeah,
let's call this the last question.
yeah.
Some economists are predicting a roaring 20s as the economy reopens due to the high savings rate in the US. What is your prediction of the US economy in the year ahead?
I think the idea that we could have, a strong national economy over the course of the next decade in general is plausible. For Hawaii, unfortunately, it's complicated by the migration patterns that I mentioned earlier. People are leaving on net, and so it's hard to imagine. For Hawaii, it's hard to imagine an economy that's growing when more people are leaving than the combination of people coming to Hawaii and births, less deaths, right? The combination of in-migration and natural increase. So out-migration is larger than in-migration plus natural increase. That it's hard for me to imagine that Hawaii will participate as robustly. It's not out of the, it's not out of the realm of possibility, and I hope it's the case. But I tend to be so much more discouraged nowadays by what I see out there. For example, not to beat a dead horse, but I did find these data here. Right here are what's called the visitor plan inventory for Hawaii. This is a metaphor for the larger question of where do we go in the 2020s. Okay, so what do we do in Hawaii? We export tourism receipts and services, number one. Number two, we export strategic defense services, yeah? And then and that's all that's on Oahu. And then number three, everything else. Everything, just like everywhere else does one good thing and then has a backup thing and then does everything else. Nail salons, auto repair, right? The non-tradables, so to speak, consulting, okay? And it's true, as remote work has now underscored, you can be in Hawaii and work anywhere. So all of the possibilities of the 2020s are there. But if the main thing we do is export tourism, goods and services, and we're not growing the productive capacity, right? These are the numbers of units. We grew the productive capacity in the 1950s and 60s and 70s and 80s, and then we stopped. And all of the increase since 1989 is vacation rentals, whether it's on Oahu or whether it's on the neighbor islands. All of the increase since about 1992, I correct myself. No, since 1989 or 88, all of the increase since the 1980s is vacation rentals. And so we're not managing the problems associated with tourism, and our next objective is to wipe out the only part of the productive capacity for our principal export that's actually increased. I don't understand how extinguishing productive capacity doesn't end up impoverishing the population. And I think people tend to suspect I'm right and are voting with their feet. They're leaving. So to get to where we could be in the 2020s, it seems to me, among other things, we need to figure out how to manage tourism's negative externalities, the side effects, the unintended, uncompensated costs that are associated with the economic activity. And I think we need to increase productive capacity, right? Just keeping the same buildings we had 30 years ago is not going to do it. I mean, for every Disney Aulani, there's another 1,000 rooms that went away, that just got old, became apartment buildings or whatever. And yes, we need the housing, but we're not going to need the housing if people are leaving. So the big challenge for Hawaii in the 2020s is that we just download the latest update to the software and we can stay on the escalator of productivity growth. But unlike the Intermountain West, unlike Idaho, Nevada, Utah, and Arizona, to which states people are moving, we have the opposite problem. People are leaving. Now, a lot of people will say that's a good thing, and I agree. And you know what? They should leave so that I can stay. But I just don't see a path for Hawaii participating in such a 2020s outcome that isn't impaired by net outmigration, unless we figure out a way to restore some balance that we really haven't begun. Here's how you solve too many people on the trail. Here's your solution, right? Too many people on the Hana Highway. Well, I guess you're not charging enough. I mean, really, you can't make a toll road? You don't need somebody to take the toll. You just scan the car and right? And they go to their smartphone app and there's right? There's the fee at this time of day on this day because of that many people on the road. And I'm not talking about $5. I'm talking $200. You know what I mean? Unless you live there, in which case then it's free because, bro, you live there. But I don't know why we let people go drive on a one lane. I mean, it's just ridiculous. If this was Disneyland, would you let people go inside for free? Hell no. Plus, you'd have fast pass and reservations for timed entry. You know what I mean? So we're not doing. We haven't even begun to do that stuff. Talking about, you know, standing in the face of this tidal wave of vacation rental proliferation, right? The investors are doing it. It's just like timeshare 30 years ago, 20 years ago. Everybody said we don't want timeshare, and there it came. And now timeshare is 30% of all the inventory on Kauai is timeshare, which basically invented timeshare. And 20 years ago, what was the conversation we're having 25 years ago after Iniki? We don't want timeshare. And I'm saying the same thing, bruh. Your choice is timeshare or nothing, not timeshare and something else. Then nobody's going to build a hotel. They're just going to build timeshare because you just had 2 hurricanes and they don't want to own the hotel. They want to sell the intervals to a bunch of people so that when the next hurricane comes, those guys own the hurricane, not, you know, not Marriott. So I just feel like we're fighting about the wrong thing with vacation rentals. We need to figure out how to manage its impacts, you know, and part of it is boundaries. No question about that. But and I use Oahu as an example because it's so ridiculous. You said you're going to ban vacation rentals in 1989, 30 years ago. How did that work out for alcohol in the roaring 20s? Only the criminals made money. There you go. How did that work out for Pakalolo 30, 40, 50 years ago? Same thing. How's it going to work out for vacation rentals? Guys, already we call them illegal vacation rentals because those the buggers making all the money. So I just think we got to get realistic here and, you know, sync up the management with the supply response, right? There's not enough housing because not enough housing is being built. Boom, end of story. What you do about the other stuff is a different management problem. Has nothing to do with whether you build housing. And by the way, just for the Kailua people, all the vacation rentals are Makai. They're not affordable housing, right? Vacation rentals are the expensive homes, not the cheap homes. I live in the cheap homes, right? We all live in the cheap neighborhood in the back. That's why we need the right of way to the beach. And I'm pretty sure we have a future if we can sort these things out and stop beating ourselves over the head about the wrong things.
Well, mahalo, Paul, for providing us with an informative and entertaining session. And mahalo
Thanks.
to all of you for attending this webinar. Stay safe and healthy, everyone, and have a great week. Thank you.
Mahalo.
Mahalo.